morning and welcome to the surprising complexities of measuring ESG, a webinar presented by the Frank Hawkins Kenan Institute of Private Enterprise at UNC Kenan-Flagler Business School. I'm Gerald Cohen, Chief Economist at the Institute. The goal of the Kenan Institute is to develop and promote innovative market-based solutions to vital economic issues. Our grand challenge this year is to research the opportunities and potential challenges of stakeholder capitalism. In our exploration of stakeholder capitalism to date, we have found significant shortcomings in a critical building block, ESG measurement. Our insight on measurement issues found a wide variation in biases in existing frameworks, as well as challenges in differentiating between internal and external metrics, frameworks, and standards. Our conclusions were to create narrower ESG metrics that meet the needs of specific clienteles, tailor ESG reporting to financially material information, set standards in a transparent, neutral way free from political influence and agenda, make reporting mandatory, and treat impact accounting, the idea that you can put a monetary value on each issue with care. Joining me today to help sort through this surprisingly complex issue, as the title suggests, is a cross-sector panel of experts who grapple with these issues each and every day. I'm pleased to introduce Rachel Bonfante, who is Senior Advisor for ESG Engagement at Chevron, Sharmila Shah-Qassam, who is COO of NASDAQ Asset Owner Solutions, Meredith Miller, who is Managing Partner of Corporate Governance and Sustainability Strategies and a Board Director at the Global Reporting Initiative, Elizabeth Ming, who is Audit Partner of Asset Management at KPMG Impact, sorry about that, Elizabeth, and Tanya Williams, who is Head of External Engagement and Corporate Responsibility at SoftBank Group. Our plan is to spend the next 40 or so minutes in discussion before moving on to external Q&A. But in the interim, during the discussion, please submit your questions at any point during today's program using the Q&A button at the bottom of your screen. Last week, the SEC took on one of our recommendations, proposing a rule that would require public companies to disclose climate-related risks and greenhouse gas emissions. The SEC is currently taking on comments to their proposal. Meredith, as someone who is on the GRI board, how would you respond, and thinking about this from your company perspective, how would you respond to the SEC?
Sure, thank you. And first, thanks to the Kenan Institute for inviting me and to be on this panel with my distinguished colleagues here. So just by way of background, just to set the context, GRI is the Global Reporting Initiative. It is one of the two standard setters for ESG data and corporate reporting in the world. The GRI was established in 25 years ago. Its audience are corporate issuers or companies. It focuses on the impact that corporate activities related to the environment, the community, and people that companies have on people and planet. So it's sort of external in that regard, and the information is in the public domain. And it, as Gerald said, it is the standards are set by an independent bodies that have multi-stakeholder input. Just also by way of background, there is another standard setter in the world as well, which is the International Accounting Standards Board, and its parents is the International Financial Reporting Organization, and they most recently absorbed SASB into their body, and so they're focused on enterprise risk and the impact that companies both have externally and that these sustainability factors have on companies. And so the interesting thing is that GRI is now a co-constructor with the European Union on their now mandatory standards and legislation that is going to go in the next year or two on both financial and non-financial reporting on ESG. So if you're US focused, think about what's going on in the EU. This is part of the big green initiative, and this would be mandatory on over 5,000 companies in Europe and on US companies that have certain number of employees. So these standard setters are different from some of the frameworks that you've heard about that Gerald and other speakers will be talking about. Reporting frameworks like the TCFD. There's other human rights indexes and reporting, and so those are usually, used and adopted by corporate reporters or companies as their ability to sort of comply with some of the standards that are being set. And finally, there's these data metrics that come out of certain companies like MSCI or ISS. CDP. There's a whole alphabet soup of data, which has now grown exponentially with the increase in ESG. And also, just by way of background, the COVID and the social justice movement, racial justice movement in the United States has really increased exponentially investor interest and validation of the needs to look at the impact of company actions on people and society, and as well the role that community and stakeholders play. So getting back to GRI, where I'm a board member and serving in that organization. So GRI recently has sort of taken a quick look at the SEC standards, proposed standards on climate, which just came out last week. It's a 500-page proposed rule, which I encourage all of you to look at the fact sheet and then to look at the implications. And one of the I guess the sort of foremost reaction, especially in the institutional investor community, is that this is a significant and welcomed major step forward in climate change standard setting. As we know, compared to other standard setters, the SEC standards would be mandatory. So this is a really, really important step. And the GRI is very encouraged by the fact that the standards were linked to net zero goals. So I think that's an important differentiator there as well. And as well, looking at, they really focused heavily, and you'll see when you read the fact sheet, in really pressing companies to look at the gap between their public commitments on climate change and the actions that they're taking, the goals that they've set, the processes that they've undertaken, and the capabilities. And it will require financial reporting and assurances on key parts, which I think are all very positive. Where I think GRI and perhaps other bodies may differ or raise some concerns and try to encourage the SEC to go further would be on Scope 3. Which is the impact that a company's supply chain vendors, contractors may have, and on climate change, and they're reporting up through that process. There are safe harbors built into the SEC proposed rule on that, and also some safe harbors related to smaller companies. I think finally the GRI and other bodies would be interested in trying to bring the ambition of the SEC up to the global standards. Both there are proposed standards by the EU on climate as well as ISSB currently. So the SEC standards are now sitting among 3 global standards that are now out for proposed comment. So it's important for people in the audience to realize there are 3 in play, and folks are now comparing them across the different standard setters.
Well, Meredith, thank you. And actually, you've added to a level of complexity that, or indicated the level of complexity that, and I'm going to turn to Rachel, who works for a global multinational company who is likely to be helping or thinking about managing all of these standards. So Rachel, how will Chevron kind of, what would Chevron propose in terms of how one handles these standards, and how will Chevron respond to them?
Yes, so thanks, Gerald. I think Meredith pointed out that it's 500 pages, and we just stood up yesterday, actually, a large cross-functional team bringing our internal controls, our audits, our financial reporting team, our SEC lawyers, just about 12 different functions really to look at this SEC rule, because it is that significant. I think Meredith pointed out it is a big step forward from a US regulatory point of view. So we as Chevron, as a carbon intensive company, we've been, I think, perhaps given a little bit of an advantage because we've been grappling with how to report these issues for a long time. So I think we've got some good experience from using those voluntary frameworks that Meredith talked about, and particularly the TCFD. That's been a real game changer. So we are definitely in favor of well-designed mandatory climate reporting, because we feel like the voluntary frameworks and the voluntary approach have probably gone about as far as they can now. We've got some very good feedback over the years that we have been issuing our voluntary reports aligned with TCFD on the kinds of additional information that investors and other stakeholders are looking for. So we do recognize that this is a big shift from that kind of voluntary world, where I think it's helpful to have ideas kind of bubble up and get tested, and then shift into a much more strict regulated world where, you know, people are really looking for that comparability, that consistency of information to help particularly the investor community make those decisions. So as I said, we've been lucky that we've been voluntarily reporting against TCFD. We've got scope 1 and 2 targets. Scope 3 has always been a huge challenge. I don't think that's going to change. And I think Meredith's point about, you know, looking at scope 3 and trying to think about what's happening in other jurisdictions and how they're approaching it is definitely going to be part of the comment period and beyond. So while we're thinking about how this proposed rule is going to impact our audit functions, our governance, our processes, our controls, I think it is definitely a watershed moment. And in terms of some of the challenges, given there is that global context, I do think that is pretty significant. I don't think there's any way of getting around the fact that US companies, if they are present in several jurisdictions, are very likely to have to report slightly different data, slightly different methodologies multiple times. So this idea that, you know, everything is consolidating and there's not going to be any complexity, I think is a myth. And I think that's a big challenge. You know, I just don't think there's any way of getting around it. But the other challenge, I think, is that methodology. We, as Chevron, have spent 1.5 years within our sector association trying to agree as a sector, which already, as I said, has got good experience in this space with this data and these kinds of metrics, trying to agree what we all mean by a scope 1 methodology, for example, or a scope 2 or a scope 3. What do we mean? What is the best methods, the best units to use, for example? That took 1.5 years. So I think that is a big issue that perhaps the SEC needs to grapple with a little bit more, is to set a consistent methodology. I think if you don't do that, it is going to be very difficult for investors to really be able to compare apples to apples. And I think, as I said, that the EU approach is going to be slightly different. The IFRS approach at global level is going to set a baseline, but it's probably going to take a slightly different approach as well. So really getting to grips with the methodology and understanding that methodology is going to be important. And then the assurance requirements, the level of the assurance, who is allowed to carry out that assurance, and just frankly, the lack of depth of experience within the auditor community is a really big challenge. Talking to some peers about the EU taxonomy yesterday and our experience with that, there's a lot to do there. So I think phasing in, I know some people are unhappy with the idea of phasing in assurance requirements, but I honestly think that the market has got some growing and some capacity building to do there as well. So again, another issue for the SEC to deal with. And I'll leave it there, Gerald. I'll let others chip in.
Thank you. Tanya, as an investor, how will these how will kind of the proposal affect your investment process? Are there downside risks that come from it?
Sure. Thanks for having us. This conversation has already unearthed a number of really interesting things and questions, and certainly the complexity, especially as you think about the different industries who will have to comply. A couple of things. First of all, I think that the mandatory disclosures, really a lot depends on a couple of factors for investors. What stage of investing are you involved in? So early stage or late stage, certainly more of a burden for late stage companies. What sector and industry? Obviously, Rachel is in a high risk sector. So that really matters for investors. And I guess the other thing is sort of where you are as a company or an investment firm in your ESG journey. Right. So if you've been thinking about this and talking about it, Rachel just, said they've been thinking about this and working on it for, a year and a half. I'm sure I know that others have as well. So I think that really, matters. So for instance, if you're like, us, our company, we have been working on and gathering some of this information. So the lift is a little less than a company that, maybe like tweaking, and truly, I think everyone agrees that definitions and standards are helpful in terms of that, so that, we know exactly what we're talking about. And even within companies, we're not, collecting different data. Some of these slight differences really make it, really are important. So I think that, that's really important for folks who haven't been thinking about this, who've been like, holding on, it's not happening. I think that the burden can be more significant. But just to wrap it up, I think, investors, we have to remember, investors care about a couple of things. They've talked about this. They don't want to be disadvantaged in the process, right? They have to collect something that someone else doesn't. That's a disadvantage in terms of time and whether or not folks want to work with them. That, I think it's always important or to right size sort of how much influence investors internally have, when they invest in a company. It doesn't necessarily mean, especially for VC, that they can just tell them what to do and they'll have to do it. It's an influence game. So I think folks need to really remember that. And then they talk about, relevance, right? Especially when I talked about what stage you're in. If you're an early stage company, you may go through many iterations. The rate of failure is exceptional. And so how are we spending our time and energy? What are we asking companies to spend their time and energy on? I think are really important factors. But the upside of this is that standards and metrics really help even the playing field, right? Now we're all, talking about the same thing. If it's mandatory, companies have this information and they are able to, to disseminate it. We're comparing apples to apples, so that can be good. And I think it also helps investors. Folks should remember that the decisions don't end with investment, with capital allocation. It helps them to give something in a regular sort of reporting to help monitor and track, and hopefully help with mitigation, or to give companies the benefit of their expertise or scale. And maybe even to spur innovation for companies that they can invest in that are addressing these issues as well. So just a couple of thoughts there.
Thanks, Tanya. So you've raised this, or a number of people have raised this question of accounting. We happen to have an expert in accounting and thinks about ESG from an accounting standpoint. So Elizabeth, where do you think these are going in terms of, or how are you thinking about reporting these? And I realize it's a 500-page proposal that they just dropped a week ago. So maybe you can even just frame it from a broader perspective than just the SEC proposal.
Sure. Yeah, I think maybe one point of encouragement from a financial reporting perspective, it's historical in nature. So the proposal isn't asking you to predict potential implications on your financial statements. disclosures around potential implications are required if you're, to the extent that you're already doing that. So certainly industries that are highly impacted by climate are already doing that analysis because it's important for the financial sustainability of their organization. But I think that's just an important context to have. And so it's really, you know, about incremental disclosure about the things that have already occurred. And I think it did a good job of being clear about, you know, the materiality of, you know, what would be required and what wouldn't be required with respect to financial statement impacts. I think one of the biggest risks for organizations will be around the completeness of risks and the financial statement impacts. And so, but I think the spirit of it is really acknowledging that that this does have financial sustainability implications to organizations, and investors think about it and make decisions based off this information because of the financial implications. So I think it's just important to keep that in mind when you think about the financial reporting aspect of the conversation. And
Thanks.
from it, I think or who made the comment on the issue, I think it was Meredith that made the comment on assurance. But I think it's a really great point, and it's something that we as an industry are navigating on several fronts. One, assurance and verification is a term that means something very different to different people. And so I think there definitely will be a process for it. Obviously, in a financial statement world, everybody understands what audits and reviews are, and those are typically done, or they're always done by independent accounting firms. But you've got another set of assurance activities that are being done by all types of providers and according to all different types of standards. And so I think there definitely needs to be, you know, a coalescence around what does assurance mean and who really has the credentials and the process to be able to issue reports that are evidence-based. I mean, I think that's the spirit of assurance, is an evidence-based opinion or conclusion on that information. And then certainly, you know, the extent of that and what does limited assurance versus reasonable assurance really offer the investor. And so that journey is yet to be, I think, really progressed, but it's a good step in the right direction. And then there's obviously a resource component. So on highly technical emission accounting and matters, I think that you know, the workforce to do that work is probably not quite up with the demand that the proposal is asking for.
That raises an interesting question, and as part of an academic or interesting issue, and as part of an academic institution that is trying to train accountants, people that with a group that a lot of people who are interested in sustainability. Maybe I'll suggest to our listeners or out there, or our webinar participants out there, that you might want to get into the business of climate accounting. It seems like it's going to be a big growth business. So maybe I'm going to point my students in that direction. So I would love for us to continue to talk about the proposal and climate issues, but and I'm sure we could have a 12-hour webinar on that. But I think we should just, in the interest of time, shift gears slightly to a broader question. And you know, and this discussion and our discussion with business leaders has highlighted that there's kind of no one-size-fits-all solution, and that ESG integration is a constant communication challenge, both internally and externally. Before I do, Rachel, you're raising your hand, so maybe I should. Oh, sorry, that was I want to make sure that I don't miss anything. So this communication challenge, Shar, how do you handle that?
So
How do you handle communication challenges internally, externally, between investors, between businesses?
Sure. Let me set the stage as well. And thank you very much for having us here today and having this discussion that, to me, sounds very different from some of the other conversations where we're just defining ESG and talking through the fact that there is no good measurement, lots of all the issues, and actually talking about some of the opportunities and where the regulatory is going. Just again, as setting a little bit of a stage, I'm coming from the standpoint of an asset owner, which people may or may not know that term, but really what it is basically endowments, the foundations that you donate to, the pensions that provide for beneficiaries. And that's a stakeholder in this ecosystem that is also being challenged with what ESG means, both for the organizations in terms of objectives, but also how they're going to measure it. And so these are the organizations that invest directly in the public markets and the companies that we're talking about in terms of disclosure. They also invest in asset managers like Tanya, who are actually out there trying to assess this themselves. I think that lends itself to a little bit of sort of the challenges of what internal and external means from a communication standpoint. You know, there's the internal looking within an organization to figure out what is the most important part of ESG, because we're talking about climate, but obviously there's other elements of it. And for a universal endowment versus a pension, there may be a very different target or goals. Then when you go outside of that, obviously you're trying to communicate with the economic community, the industry, about what you're trying to do, and actually in some ways, hopefully promote certain objectives, whether it is from the standpoint of, and I think we talked about this a little bit in the prep call, I mean, ESG for a long time, even amongst the naysayers, I think really can be explained as risk management, right? There's positive and negative externalities that we're trying to quantify, and that's been fundamental to every investment process. But what going forward, I mean, sustainability, which has been mentioned more than once, becomes an opportunity for looking how businesses can grow in light of many of the macro forces that Meredith very well articulated. I mean, a lot of these points are about sort of the businesses that are going to have either tailwinds in their favor or maybe headwinds because of the way they're treating some of these items, including the climate. So I think it becomes a navigation of trying to communicate and, you know, taking it back to what we're trying to do at NASDAQ, because everyone thinks of NASDAQ as the stock exchange. They're obviously in the heart of the capital markets with how they work with companies. There's technology that they foster to try to help communicate some of these disclosures from the corporate side to the investors. But then my new division, which has been created, is to help sort of the other side in terms of how asset owners are looking at this, how investment managers are trying to assess this, and in some ways try to convene around not what the right way to do this, because of the data and the objectives are going to vary. As we've clearly said, this is a very complicated area, but try to bring people together from some education. And I think one thing that helps with the communication is technology. Technology is going to be a catalyst to get all this data both out to the appropriate stakeholders, as well as allow those stakeholders to digest. So maybe that's a little bit of a different response than you wanted, because I know when you're in the heart of a company like Chevron, you're talking about communication as it relates to shareholders. When you're looking at as an asset manager, thinking about how to engage, whether it's to promote or to require disclosure. But I think where I'd like to come at it too is that I think a lot of this communication can be solved through the technology and allow people to assess it the way they think best for their organization and hopefully get to the goals that they're speaking to. So happy to come through that in a couple of different ways as we get further into the dialogue.
So Meredith, following on Char's comment about this, following on Char's comment, and I was trying to boil it. I was going to try to have a concluding sentence, but I don't think I think it's too much to say. So how are, you know, what are the particular strategies that you advise as somebody who is in this business in terms of communicating and kind of following from what Char said?
Sure. Yeah, every speaker has just incredible nuggets here. It's really hard to crystallize. You know, I would say for even your students in the audience, there's an interesting and important area around the governance of ESG data and communication. And when you're in an organization, whether it be a nonprofit or whether it be a for-profit corporation, it's really important to sort of figure out who are the decision makers and who are the communicators, and what are your most material issues that you have identified as related to your business strategy. And some companies have actually just sort of done a materiality mapping based on what they think their stakeholders view as most material to the business, whereas investors often look to the company to also understand what the company believes to be the most material, which is a little bit more narrative than what's in the 10K, which is typically very boilerplate. legal language. So from the work that I've done, we often look at the board of directors and understand whether it's a full board decision on the high priorities for ESG and how it's integrated into the business strategy. And then we look at the different committees and how it's threaded through. Most recently, for your listeners, there's been a lot of changes to the compensation committee where investors have really pressed, an update from the 1950s, where all we were looking at was the pay for executives and the named executive officers. And now with the social justice and racial justice movement, with COVID and health and safety, Leo Strine, former judge Leo Strine has put out a paper a few years now ago called Reimagining, the Compensation Committee. And in it, there's this, this quest to update our thinking about compensation. It can't just be in isolation of workforce statistics, and it's not just the CEO to worker pay, but what is the role and the treatment of human capital management? What are our policies in the committee on sexual harassment and arbitration, on pay gaps, gender gaps, etc. Health and safety issues often come into the compensation committee. So there's an interesting move to both change the charters as well as change the competency of board directors on ESG. So for your listeners, there's been a number of developments in the investor community where there has been a move to examine the climate competency of directors. Do they have the knowledge, experience, and skills that they need to be able to provide board oversight? And that is their role, board oversight, which would include this reporting. And as the speakers before me spoke about the assurance, the audit committee under the SEC rules would have to actually include that, some of the data. The data goes into the 10K. There has to be attestations by different board members. And so I think that's important. And then there's the role of management. Do companies have chief sustainability officers? Do they have a good connection to IR? And then there's the discussion with the workforce. What kind of communication and multi-stakeholder input is a company receiving? And now this is going to become increasingly an important question, which is what data and what information are you getting from, and how are you identifying your stakeholders in input to these ESG issues? So I think that the other thing that we can talk about a little bit later is, staying ahead of the curve with sessions like this. What's on the horizon? You have to know that the SEC momentarily is going to come out with a set of also ESG type new metrics on human capital management. Well, what can you do to be prepared? Well, one thing would be to, write this down, please. Look up the websites of the Human Capital Management Coalition. I was with the UAW Trust when we put in the petition for the rulemaking for this in 2017, but you can see all the subsequent comments on that. Be ahead of the curve, understand just transition, the nexus between what's happening with workers and climate change. That's a whole movement and disclosure. So we can talk a little bit more about that later, but I think really doing a diagnostic on your governance of ESG data and information and communication is a great first step.
Wow, this is phenomenal. I'm gonna, Meredith, actually following on your point, I'm gonna just kind of turn it to say, one of the things that you kind of alluded to was that by reporting these things, you're kind of helping you're helping the stakeholders understand the kind of benefits of this reporting framework and what the company is doing. And so we've thought about this question of kind of stakeholders, where we say, if a company can understand its stakeholders better through measurement issues and report to those stakeholders what they're doing through measurement issues, it could be a real win-win. So Tanya, kind of from your perspective as like, where do you see, what are you telling companies, what that they should do so that they could kind of enhance these win-win solutions?
Yeah, I love the framing of this, first of all, the win-win, because when we're talking about ESG, we're often talking about burden, we're talking about cost, there's so much confusion, there's lack of standards, we're talking mandates, nobody likes a mandate, and I think it's easy to get burdened, bogged down in those things and not think about the positive. And in fact, when I was skimming the outline for the SEC's, their fact sheet, not the 500 pages, I noted that, one of the things that they, right tucked therein was like, and you may report on, opportunities that are provided, by this as well, after like, pages and pages of scary, things. So I think this is great. I think that to continue on with what Meredith was saying, communication, but professionals within companies, I think in a different way, thinking about brand and other things, really need to get smart on this, and they need to get smart on it quick, because they, there are a lot of things that companies are already doing that they're just not framing in terms of ESG, that they're not going to get credit for it because of the way they're talking about it. And also because of the way that data is great for ratings and things, there's some things that you should be thinking about and talking about, and keywords and things that are helpful in communicating what you're doing, even if you're not reporting on it, because the data is being scraped and they're, and reported on in different ways. So just at another level, I think that it's really important that you're talking about that you're talking to different audiences, many of your stakeholders. We're talking about climate today a lot. There are other aspects of ESG and things that people care about, different stakeholders care about, and you want to make sure that you're speaking to those things as well. So to Meredith's point, after what's material, who your stakeholders are and what's important to them, you really want to continue to have a continuous conversation with them, because what's material will actually evolve. And so it's a continuous conversation. But you asked me very specifically, what do I think is the win-win? And I want to answer to that. And, I think that we really need to talk about, the support that research and data has given us for the real benefits of ESG, and the competitive advantage that it can give to companies. And so it's not, investing in this for, because it's the right thing to do, because it's a nice thing to do, it's a moral thing to do. There are real benefits to this. And I think we have to really talk about that. We have to educate companies about what that means for them, and how engaging in this over the long term is good for them in terms of, how much it's going to cost them to, the cost of capital, in terms of, retention and recruitment of talent. We have a generation of, workers who really care about, to match their values with the work that they're going to do. We have consumers who are getting more and more information, who are making buying decisions based on their values and what they know about companies. And the more information there is for them to gather, which this is helpful in, doing, means that they're going to be using that to make decisions. And so there's a lot of competitive advantage to doing this. It's not so burdensome. And so I just think that, and I don't want to be too Pollyannish about this, there are costs and burdens. There's some more for others, some than others. And so I think that just an equal sort of balancing of like the good that can come from this, that can help us to all, get in front of really big problems that we have unfortunately ignored or put aside or kick the can down the road on for years, can be addressed by this. And we can get in front of the new ones as well, things that we haven't been thinking about. So there's a lot of positive stuff here. I think we should think about that and at least give it equal billing.
So Rachel, you work for a company that I know spends a lot of time thinking about how you can communicate the work that you're doing. And we've in our previous discussions, you've mentioned kind of both internally and externally. Can you share some of those insights?
Sure, yeah. And I'll pick up on a point that Tanya made, because I think it is really important. This is ESG is a two-way conversation. It's a tool to help different stakeholders understand how we are managing very complex risks. That's fundamentally what ESG is about. And personally, as somebody who actually goes out and directly engages with our investors on ESG topics, and there are tons, Meredith and Tanya, you're right, it's not just climate, it's very broad. I think the most important part is listening, and really listening and understanding to what those stakeholders want. And that's where, to go back to the first points that I made, where we've been putting out very detailed climate focused reporting for the last 5 years or so, but that has evolved, and it has evolved not only from the voluntary frameworks out there, but it's evolved mostly from the direct feedback we have received from our employees, from local communities, from unions, from investors, and we have actively tried to demonstrate, hey, yep, we hear you, we understand this particular aspect is important, and respond to that. But it is true that probably the most amount of time that we spend internally is with our employees. This is the number one issue for them, is energy transition. They are hungry to learn about what the company is doing, the kinds of technologies that we're investing in, the progress that we're making in terms of reducing our carbon footprint as a carbon intensive company. They really want to understand what is happening, and they want to be ambassadors for the company. They want to feel proud of and be able to talk in positive terms about what we're doing, whether that's on diversity and inclusion issues. We have a very active set of employee networks for different constituencies internally, whether that's women or Black employees or Spanish speaking employees, so that each of these different groups comes at these ESG angles and these issues slightly differently, but you do need to talk consistently to these groups. And one of the most important things we found is to give them progress updates, and so that they can see, yep, we're still doing things, and to have our senior leaders from CEO down to line management level, again, talking about what we're doing. It is just a great conversation to have. It throws up some really interesting insights. It gives us that forward-looking issue as well. What are people worrying about? What do they want to know about, whether it's biodiversity or plastics or human capital management? Meredith mentioned that. There's just a lot going on out there. So it is time intensive, but I think that is the crux of ESG, as you are talking about sometimes risks that can be intangible until you start to nail them down and measure them with specific metrics, for example. So a lot of communication needed, but a really rich discussion, I think, on ESG. Oh, you're on mute, Gerald. And you're still on mute.
I always think that I have Zoom covered, and now I've managed to get people to lose my screen. So I couldn't unmute myself. So I just, following up on that, Elizabeth, from a private equity perspective, how are you thinking about these kind of change agents and incorporating the information, incorporating ESG into the discussion?
Sure. Yeah. I mean, I couldn't agree more with the sentiment Tanya shared, just around, I mean, it's such a complicated conversation. You have got certainly the degree of influence you have with the level of ownership, and then you've got, it's different by geography in terms of regulations, it's different by sector in terms of, what's decision useful and meaningful. And so if you're thinking about, mandates at the advisor level relative to the company level, they're kind of two different conversations. And so certainly a lot of complexities there, but I think the conversation around the value proposition is such a critical part of this, I think, in terms of moving the needle. I mean, the private equity, private markets have such a huge role in influencing the change. And I think helping the industry see this as much more of an opportunity, more so than a compliance exercise, is really important. And so I think we're well on our way, and I think from a research perspective, it would be helpful to continue to see research come out about what those levers are that really both create value and create the change we want to see. And so that the industry can focus their efforts, whether it's by geography or by sector. And from certainly from a measurement perspective, I think the definitions and sort of a coalescence around how these things should be defined is important. So it's not this kind of catch-all grab of data that across the industry is being measured in many different ways, so that when you're trying to compare and understand trends, you're not comparing apples to apples. That's obviously what a lot of these frameworks and initiatives have been after for many years, but kind of understanding like the use case of each of those metrics and how things should be defined is, I mean, you'd be amazed when we go into Assure, very, organizations that are very refined in terms of their data and reporting still have what, challenges and the definitions, even internally in an organization. The way they're picking up data across business units or geographies is different. So if you think about it in a private equity world, that's just one company, then you aggregate however many. So I think the complexities are just unique from those items I just described, but I think narrowing the conversation around that value piece and the opportunity piece, data is powerful, as we know, will really help drive the change I think we want to see on a number of these issues.
Thanks, Elizabeth. So I had 5 other questions teed up, and I'm just gonna I'm gonna ask Shar to maybe combine a couple of them. So one is where do you think the government is going? I know Meredith alluded to that, and because I want to get to the like, what is an academic institution? So some of what can researchers do to help you in answering these questions?
Okay, let me try that. I definitely have some viewpoints on the prior question, but let's just get to the meat of what you're talking about.
Or feel free to answer that question.
No, it's all right. I know there's a lot to cover, and I saw the questions in the chat as well. So in terms of where the government's going, obviously I don't have a globe, to kind of predict the future, but I do think a lot of what we're talking about here in terms of public company disclosure, whether it's on climate, obviously NASDAQ had a stake in putting out a board diversity rule last year where you had to explain why diversity wasn't on the board. There's going to be translation into what that impacts investors. And so there's already discussions about managers or funds. Those are vehicles that managers use to allow for investment, whether it's public, like a mutual fund, or private equity funds, that how they reference themselves as ESG focused. If you say you're ESG focused, you have to prove that. And then, it would not be that difficult to believe, and it's already happening somewhat in Europe, is taking those standards and trying to figure out what investors can invest on it. Not to get too into the weeds, happy to talk to people offline, but obviously in the US, there's been different ways of looking at ESG and what investors could do. Some of that was politically driven based on different administrations in the recent past. And so what you could consider as non-pecuniary interests that still allow for you to be an investor serving your beneficiaries and the community and the objectives of that investment program. I think that's going to be fascinating to allow for more flexibility, because a lot of what's already been said is that you're actually looking not just for companies that are maybe bad actors and trying to understand how you may want to change your investment philosophy or your investment selection, but really also looking for opportunities and impact. And as investors, we're looking for returns, and we shouldn't take this ESG element out of the equation in terms of that. I think your second question is about what academic institutions can do. Like it comes to data for me, and I know NASDAQ really wants to work with other industry leaders and already is working with some about taking that data. For example, if we just take diversity as one aspect, we're collecting a lot of data, obviously, from public companies, both on boards as well as their internal staffs, and sort of what their processes are, both quantitative and qualitatively, to encourage that. At NASDAQ, we're also looking, and I think Liz was talking about in terms of private equity, that's a little bit more opaque. So how can we also provide some of that data for asset managers, both in the public and private markets, to investors? So that has been a project that was launched last year. It started with public managers, now it's moved on to private managers. And it's not just about getting the data, because some of this is not anyone's fault, but the data is complicated. And so how you can collect it, and we use a platform called eVestment, and we provide that data right now for free to any investor who wants to look at diversity in terms of both their asset managers as well as the diversity in the public companies. And I think where academic institutions can help, as you usually expect, is taking that data and analyzing it from an objective standpoint and showing us where maybe things are progressing or not progressing, because we can discuss all day what the data is, we can discuss the fact that we need to measure it, but we really need stakeholders outside of the, I think, industry to be looking at it and giving us some objective assessments. So I hope that answers some of it, and I'd love to come back and talk more about these things.
It does, thank you. And again, for the students out there, PhD undergraduates, look at all this cool data that we have. And I think, and I'll say the Keenan Institute is working on these very questions and looks forward to partnering.
I'm jealous. I wish
you.
I was a student. I'm a recovering CPA, and this is a great time to be in the weeds of data as an investor and accountant.
So I mean, we had a phenomenal set of questions, and I'm going to give ourselves 7 minutes to try to do a lightning round of these. And I apologize to everybody whose questions I don't ask, so I'm going to answer one of them. Somebody asked about a carbon tax. Economists love a carbon tax. We think it's the solution. If perhaps some of our speakers may disagree with that, but we can have a discussion about it or not. But I wanted to raise a question that we're also grappling with at the Keenan Institute about small companies. So how do startups who don't have a lot of money, or think about how to integrate ESG into their without given the limited amount of funds, like what can they do to be helpful? Or what can they do given their limited budget constraints? So let me start with that one.
I can jump in. Should I jump in? Yes, okay.
Please.
So the GRI, Global Reporting Initiative, does have a small company framework and tools and technical assistance for small companies that want, excuse me, to start on ESG reporting. And it's also, I have to assume that ISSB, now under IFRS, also probably has technical assistance for small companies who want to look at SASB reporting. And so I think that's helpful for your small companies who are very new to this area, or for students who are just jumping in. There are a few websites that might be helpful. I know I saw some of the comments about the alphabet soup, and I know it's such a problem all the time, all these acronyms. But if you look at the United Nations Principles for Responsible Investment, PRI, they have very good educational materials, I'm sure along with the Institute as well, that can give you, it approaches it from different asset classes, it does the 101, so it's very helpful for you to get it. The Council of Institutional Investors also has a publicly available, sort of the ABCs, I'm sure NASDAQ does as well, and CFA Institute, all of these places have some sort of building up your capacity in sort of learning about these issues and trying to discern the different names of the organizations. But for small companies, I do believe that taking a look, and everything on the GRI is in the public domain, it's free, and then you can sort out whether you need technical assistance. And there are public reports on the GRI website that has, and as well, I think on CDP and other websites that have public reports of companies in your sector. The last thing I would mention is Climate Action 100 has a sector breakdown of its expectations in climate reporting by sector. So that may be very helpful for folks in your audience who are either small companies or big companies and trying to understand investor expectations on reporting and implementation.
So maybe Tanya, sorry.
All right, I just wanted to add one thing to what she said, what Meredith said. There's a conversation that's going on. PRI actually is leading on in this conversation about how venture capital, and other investors can help smaller companies. as they grow. And so there's an opportunity there, I think, to for companies to benefit from the size and large in scale of their investors and other groups and institutions that have or may be able to guide them, and also to raise these issues so that these folks understand and know that this is important, because obviously the squeaky wheel gets the grease. So just a little something to think about there.
So there have been a number, in a very light or super lightning round, there's been a number of questions about the S aspect in terms of, we've spent a lot of time on E. A number of people have kind of mentioned S. I don't know if people want to, if you can kind of go on a lightning round about where companies sit, where do companies sit on the S, where are measurement issues sitting on social issues, what's the future?
Why don't I start with that? So I think someone had asked the question about whether companies are more advanced in the E than the S. I think that's the traditional view, and I would certainly say up until COVID hit, it was probably true. And it's because if you're putting something into the atmosphere or you're withdrawing water, it's relatively easy to measure. There's something tangible there about physical emissions. But I think COVID in particular has driven a much greater focus on how employees are treated. Murder of George Floyd has focused attention very strongly on diversity and inclusion internally, all the way up to board level, all the way through kind of the management levels and the employee population itself. And human rights issues have always been there, but they are very, very challenging. In terms of the S, I would say the human rights ones are probably the most challenging, and that's where European Union legislation on sustainable and due diligence, which is really focused on human rights, is going to help to tighten up some of those metrics and some of those measurements. So I think it's coming. Certainly there's already regulation in place about employee data in the United States, the so-called EEO1, and I'll make a plug for the Chevron Sustainability Report. If you look at our data table there, you can see the kinds of metrics that we have to report on gender issues, diversity issues. And the other one I would point you to if you're looking for an S framework is the World Benchmark Alliance, who's taken over the corporate human rights benchmark, which is really looking at those tough human rights issues and how to kind of measure performance and progress there. So maybe that's a good starting point for some of the students.
Sure, I'll chime in really quickly, and I'll make it very, very brief. I know we only have a limited amount of time. I mean, in addition to everything I think Rachel laid out very nicely, I mean, it comes back to sort of opportunity. I mean, whether you look at it from a talent management standpoint and inclusivity standpoint, I mean, I think one of the areas which I think our CEO says much better than I do is about inclusive capital, and then how we not only have to provide opportunities for founders as well as investors, as well as look at sort of how we can help our employees and society in general, but from a social standpoint, really measure how that inclusive capital, as we reference it internally, really touches on all aspects of society. Because any objective that any of us have here in terms of sustainability is going to come from being able to participate in the ecosystem. And so that's an area we haven't figured out, but we want to convene with others to try to make that a priority of all our discussions.
Thank you, Shar. Oh, sorry.
I'd add one more thing, just a little bit of a contrary view to what Rachel was saying on the climate focus, is that the concept of corporate social responsibility has been around for a really long time. And I think it's really about, and a lot of this data already exists, certainly from an HR perspective. So the conversation is really more changing to a monitoring exercise of that data and progress on some of these issues that have come to light from, the recent events.
Always good to have some differences of opinion. So I can't say thank you enough to my panelists. Really, this has been a phenomenal discussion. I wish we had more time. We look forward to hosting you again. Thank you to the audience for an amazing set of questions. If you'd like to follow up with us, feel free to email me at gerald_cohen@keenanflagler.unc.edu. Also, if you want to be part of our discussion on stakeholder capitalism, look at our website. And we have a specific stakeholder capitalism page within for our grand challenge within our website. Also want to mention, as a follow-up to this issue on stakeholder capitalism, is that we're having Alex Edmonds, professor at London Business School, speak on a webinar in a week from now on April 7th on the power of purposeful business. A link is in the chat. He is a phenomenal person. His book has won the FT Award, one of the FT best reads in 2020. I want to thank my colleague Sydney Bannerman, who organized everything, and again, all of my panel, the panelists, all of you. Thank you very much for a wonderful discussion.